Ever feel like you're waiting on the Fed to make your next move, just hoping that the rate cut finally makes real estate affordable again? Then the Fed lowers the rate, and yet mortgage rates tick up. What's going on here? Why don't rates on a 30-year mortgage go down like they're supposed to? Imagine finally understanding how this system actually works, so that you're not stuck in analysis paralysis and paralyzed by the next headline, but you're positioned to act, that you actually know how the game works, while others are hesitating, talking about what they see in the media. You're listening to the Real Estate Fast Pass, the show that bridges the gap between active and passive investing so that you can move fast, build smart, and scale confidently. My name is Jimmy Vreeland. I've been boots on the ground and behind the scenes in real estate for years. So today on the show, we're going to be unpacking a critical question. Why doesn't a Fed rate cut actually lower your mortgage rate? And what does this mean for your investment strategy? Now, it's just me on the mic for this episode, but I'm bringing research and insight from the Collective Genius Mastermind. A few ideas that were sparked by financial strategist Jim LaCamp. So to break it down for this episode, you're going to walk away with 3 big takeaways. Number 1 is why Fed rate cuts don't necessarily translate to lower mortgage rates. 2, how the 10-year Treasury bond is your new best friend as an investor. And 3, while waiting for the perfect rate might be costing you more than you think. And here's the part that caught even me off guard. Mortgage rates are more about market trust than central bank policy. Once you see the disconnect, you'll stop waiting and you'll start buying smarter. So if you're ready to stop chasing headlines and start building long-term wealth, even in today's so-called high-rate market, then stick around for this episode of the Real Estate Fast Pass podcast. All right, welcome back to the Real Estate Fast Pass podcast. I'm going to try something a little different here. I'm just going to it's going to be me talking here. And so what I'm going to talk about is, as an investor, what is important to you by the fact that a couple weeks ago, the Fed lowered rates. But as you can tell, nothing has changed. In fact, there's been a slight uptick in the interest rate. And I know when I first started investing, I'd be like, what's going on? The Fed said they were going to lower rates. A 30-year mortgage rate should be lowered. What's actually happening? So I'm going to kind of talk through what's actually happening and why that's important for you to know as an investor. I did a bunch of research on this, and I found it absolutely fascinating. So by listening to this podcast, here's what you're going to know. You're going to know that, hey, lowering interest rates from the Fed at the 24-hour borrowing window is not necessarily going to correlate to lower interest rates. And I've been a complete contrarian on this, but investors do not benefit from lower interest rates when they're buying. The people who benefit from lower interest rates are people who already have assets. And the greatest thing about single-family real estate investing is you buy a 30-year mortgage and then boom, you have married the house, but you're dating the rate. And the rate can only go down from there as you refinance. It's one of the critical advantages to investing in single-family real estate. And so where I got a bunch of these ideas is earlier in the month, I was at the Collective Genius. For those of you who don't know, Collective Genius is a mastermind of active real estate investors. And what I love about my podcast, what I love about Real Estate Fast Pass, is I get to be a bridge between the active investor and the passive investor. And so we actually got a great presentation by a man named Jim LaCamp. He's a senior VP and financial investor. Where is he from? He's always on CNBC. He co-hosts the Opening Bell radio show, manages a huge portfolio, $500 million in managed client assets. And so he talked about that, hey, the economy right now is nobody's really bearish, nobody's really bullish. Nobody knows exactly, where the market's going to turn. I have my ideas that I may save for the end of this podcast. Not that my ideas actually matter, but trying to see here if I'm live on Facebook. I should be. But, basically the economic sentiment is that nobody's really neither bullish or bearish. Now, there are reasons for optimism. With the new political regime, there's a new business-friendly political climate. The Biden administration actually had 1.8 million regulations. And for business people, regulations aren't great. Sure, do you need regulations to make sure things are safe? But 1.8 million, how do you actually get anything done? So there should be a deregulation impact. Reason for bearishness. There's inflation pressures where I'm going to get into a lot on this podcast. There's currently high interest rates, and no one really knows what the end effect of the tariffs are going to be. And so it's very interesting. Jim LaCamp, this financial advisor, doesn't really, he's not that important, but most people are saying the Fed by the end of 2026 is going to cut interest rates by 1.6. But he said, be careful. What you need to be watching is the 10-year Treasury yield. And I'm like, that's very interesting. Why is that? And so my point is, don't necessarily get too excited. And I'm going to talk about a kind of a Jimmy Vreeland Ranger real estate principle. Here's something I want you to remember as you listen to this podcast. Investors and lenders are always seeking the most yield for the shortest amount of time. Borrowers, of course, are always looking for the least interest expense for the longest amount of time. So keep that thought in the back of your mind as you listen to this podcast. And I'm going to explain, before I get into it, I'm going to explain the mortgage securitization process. So whether you have an investment loan or a home loan, not a lot of people know this. So you got your friendly banker, who's really your friendly mortgage broker, who sells you your mortgage. Now, I use guaranteed rate mortgage. Now, guaranteed rate mortgage is not necessarily going to keep that note. What guaranteed rate mortgage or any other mortgage provider is going to do is they are going to bundle up a bunch of mortgages. And by the way, you as a high income earning passive investor who works with us, they love your mortgages. So they bundle up all your mortgages and they sell it off on a secondary market. Why do they do this? Because the original lending source needs liquidity. Let's say they loan out $10 million in a month. They then need $10 million for the next month. So what do? They package up their mortgages, they sell it off to Fannie Mae or Freddie Mac, and they get, I wrote it down, but essentially the original lender takes about 1.5 points spread. So your mortgage broker is not making that much money when he sells you an individual mortgage. What everybody in that person's company has to do is they have to package a bunch up that a secondary market opens up, that Fannie Mae or Freddie Mac will buy these mortgages. So essentially they package up a bunch of paper. Fannie and Freddie give them cash to lend for the next month. Fannie and Freddie have all these mortgages who are then going to pool even more mortgages together and tranche them together. If you've ever seen the movie Big Short, they kind of explain this process. But what institutional investors are going to be the end buyers of this. And what are institutional investors looking for? They're looking for safety and some type of yield on their capital. And so at the end of the day, it goes from your individual mortgage to a secondary market to then Fannie and Freddie sells it off to either a bigger institutional buyer. And each point in this transaction, people are getting a very small yield, probably 1.5 points. And that end investor, what they are looking for is safety of their capitals. And so let's say they lend out $10 million and they know that investors like you are going to pay their mortgage. And so maybe they're getting a 4% return over time. And that's not really beating inflation, but it's keeping their capital safe. This is a tranche of investment that keeps their capital safe. And these big institutional investors, they have high growth stuff, they have slow growth stuff. But the mortgage market is where they are looking for reliable yield. But keep in mind that at each point, everybody is taking 1.5 points. So how does it, I'm going to get into this when we go through the 10-year Treasury yield. But I showed this part, could just remember, everybody is looking for an extra 1.5 points. And so this was news to me. I just kind of learned this in the last month, but there is not a one-to-one relationship when the Fed cuts rates. When the Fed cuts rates by 0.25 point or 0.25% on a mortgage rate, 30-year mortgages generally fall 0.1 to 0.25. The Fed influences mortgage rates. This is something important to remember. The Fed influences mortgage rates, but does not control them. And now, like I said, the typical response to Fed cut rates is for every 0.25 point, 30-year mortgage is going to fall by 0.10 to 0.25. It is not a complete linear relationship. And now here are the key factors that influence how mortgage rates respond to Fed cuts. You got to look at the 10-year Treasury yield, and I'm about to get while that is important. Inflation expectations and the economic outlook are all going to factor how low the 30-year mortgage actually goes. So even despite Fed cuts, mortgage rates can continue to increase because of inflation concerns. And so other factors also play into Fed policy. And it's very ironic to me that I recommend people buy 20 single family homes with a 30-year mortgage as a hedge against the American dollar, as an inflation play. I put out several podcasts about this, or why these are such great inflation hedges. So when you're going through this and you're seeing the reason interest rates can't fall that much because of inflation, I find that a little bit ironic. And so knowing if you're sitting on the sidelines and you're like, man, soon as the Fed cuts rates, I know I'm going to get a better interest rate. Do not think like that. There is not a one-to-one correlation. So, and then me personally, I've been a complete contrarian about this. I've been saying this for 2.5 years now since rates went up, that rates going up are great for the mom and pop investor because they're going to marry the house and date the rate. And no matter what the interest rate is, eventually there's going to be an opportunity to refinance the house and get a lower rate. And I've done plenty of projections. I can do them again. But there is a cost and an opportunity cost to waiting. And that is the fact that these houses appreciate 5% a year. So every year you sit on the sideline because interest rates are supposedly high. By the way, where we're at right now is pretty average. You are having an opportunity cost because you have not set the appreciation clock. And so now let's talk about the 10-year Treasury bond. And now there is more of a correlation on the 30-year interest rate to the 10-year Treasury. Why? Because generally people hold on to their mortgages for 10 years. And so as an investor, you can be saying to yourself, hey, I can buy a 10-year Treasury, which is safe and backed by the American government, or I can take a little more risk and buy one of these mortgage-backed securities, which is what we talked about earlier in the podcast, a bunch of packaged up mortgages. So think to yourself, what's safer, a bunch of packaged up mortgages based on houses, even if they're great borrowers like people who invest with us, or the American government? Now, I'm not the greatest fan of the government, but at the end of the day, the government can collect taxes. So probably a 10-year Treasury is going to be a little safer bet. So if I could buy a 10-year Treasury or a mortgage-backed security for the same yield, I'm going to go with the 10-year Treasury. And as an investor, if I buy that 10-year Treasury, I'm going to depart with my capital for 10 years. If I buy that mortgage-backed security, I'm going to depart with that capital for 10 years. So I got to put like investment with like investment based on time. And so that's why a 3-year Treasury, a 3-year Treasury and a mortgage-backed security doesn't necessarily correlate. So 10-year Treasury and then a 10-year mortgage-backed security. Why is that safest? Because most people refi or move after 10 years. Very few people exhaust their that 30-year mortgage. And so back to the investor's mindset. Okay, cool. The 10-year Treasury is a little bit safer than mortgage-backed security. So what is going to have to happen for me to buy the mortgage-backed security? Well, I'm going to have to get a better return. So let's say a 10-year Treasury is at 4.5. To get a mortgage-backed security, I'm probably going to need a 5 or 5.5% return. So there's always going to be a spread between the 10-year Treasury and the 30-year mortgage because of that mortgage-backed security spread. Hopefully I made sense there. And so this slide right here, I'm just going through the risk comparison. And now generally this spread between the 10-year Treasury and a mortgage-backed security is 1.7 to 2.4 points. So if you're trying to plan at home, by the way, I don't recommend doing this. I just recommend buying the house and trusting the fundamentals. But generally, if you really want to get into math, you look at the 10-year Treasury and you add 2 points, 1.7 to 2.4% or 2.4 points. And then that's what you know your mortgage rate's going to be. Now, here is the problem. Let's say the Fed dramatically drops interest rates. What is that going to do? Well, it's going to create inflation. And so for someone to depart with capital for 10 years and have the reasonable expectation to not beat inflation, but not get destroyed by it, how is the government going to get anyone to buy a 10-year Treasury? Well, they're going to have to get the return and the yield on the 10-year Treasury to stay high. So this is this very weird vice that the government's in right now. Let's say they want to drastically drop interest rates. everybody, every sophisticated investor is going to be like, here's a major concern. Interest rates, inflation is going to skyrocket because interest rates have dropped and the government is probably going to continue to print money. So, but then the other side of the vice, if interest rates stay high, what the government is have to spend on debt is pretty dramatic. And how's the government going to pay for that debt? They're going to print money. What is that going to do? That's going to raise inflation. So the government right now, and people setting interest rate, is in this really tight vice. So we can lower interest rates, but that's going to bring up concerns of inflation. But not lowering interest rates is going to bring up concerns for inflation because the government debt keeps ballooning. This is really a tough spot. And so the Fed is going to have to manage this very, very carefully. But right now, every time the Fed, as they continue to lower interest rates, it's probably going to make people a little bit concerned about inflation. So what's that going to do to 10-year Treasury yields? They're going to have to keep the yield on the 10-year Treasury high. So I just went through this. If they have to keep the yield on the 10-year Treasury high, what is going to happen to interest rates? Not much. There's going to be a 1.7 to 2.4% spread between that 10-year Treasury. So I'm probably going to title this podcast, Fed Lowers Interest Rate. So what? Who cares? It's not that big a deal. So now if you're thinking to yourself, I'm never going to be able to buy real estate. I should never buy real estate because interest rates are never going to go down the slope. Well, one, I want to give you a historical perspective. And that is right now, I'll never forget the first rental I bought, 2004. I came home from Iraq. I'm buying houses, my mom and brother. My mom, because when I was born, the first house I lived, my parents did an owner finance note at 12%. So my mom saw a 6% interest rate. It's like, interest rates are at 6%. They're never going to be this low again. We got to buy now. But since the 2000s, a 6% interest rate is pretty reasonable, pretty average. So if you're looking to get off the sideline, if you're looking to start buying, recognize you're not really buying in a high interest rate environment. You're buying in an average interest rate environment. I've also been a contrarian on this too. I have enjoyed high interest rates because it is protecting us against hyperinflation. I still think you have to buy these houses because your greatest risk as an investor is that the dollar loses so much value. Whatever you get as a return it's not going to be able to buy anything 10, 20 years from now. Good thing you have a hard asset in a house and you use government money. You borrow their money on a 30-year note. And so now you're protected from interest rates. Like I've done several podcasts that these houses are just inflation hedges. But so here at the bottom line, here's what you got to recognize. The Fed saying I'm lowering interest rates, not that big a deal. Watch the 10-year Treasury. 2, also recognize we are not in a high interest rate environment. It's 6.5. It's average. And recognize if you've been sitting on the sideline because of interest rates for 2 years and you could have bought a $200,000 house, and people who did buy from me have experienced this, but they've made 10% appreciation in those 2 years. They've made cash flow. They've gotten tax advantages. So, and remember, interest rates only affect cash flow. People I'm working with, you guys don't need cash flow. You need tax advantages. You need to start building your net worth. And so interest rates are somewhat irrelevant. And the Fed lowering interest rates, cool. You know, some deals might pencil a little bit better, but remember, the funds might be coming in and driving up prices. So a couple things to watch out for. Are prices getting driven up? And if you are a flipper, lowering rates could get more people to start buying the retail deals. But I've spent most of this podcast speaking as an investor. So if you're kind of, liking what I'm saying and you're like, man, interest rates really don't matter. I need to buy these houses in an inflation hedge. I need to buy these houses so that I can build my net worth. I need to buy these houses so that, yes, in 5, 6, 7 years, I do have significant cash flow. Then it might be time to get off the sideline and get on a call with a team member of mine and see if we can start selling you and helping you build a real estate portfolio that here's what I know. If you buy 20 rentals, you're pretty much set for life. So if I want to get with a team, I want to start building my rental portfolio, give us a call. And if you found any value in this podcast, please like, share, and subscribe. So if you like what you heard today and you want to learn more, sign up for a discovery call with one of the Vreeland Capital success coaches at jimmyvreeland.com.